Usually when we talk about like a medical diagnosis, there is this underlying expectation of precision, right? You break your arm, you go to the hospital, and the x-ray shows that jagged white line.
Right, it's right there in front of you.
Exactly. The doctor points at the screen and says, there it is. It's broken or it's not. The evidence is binary. It's highly visible. And frankly, it's kind of comforting.
Oh, absolutely. We gravitate toward that kind of certainty. We want things categorized neatly into boxes.
But if you step into the world of complex intragroup corporate accounting, that x-ray machine just completely malfunctions. I mean, you might think you're looking at a simple transaction, right? A clean scan. But depending entirely on which set of financial lenses you happen to be wearing, a single, totally isolated event can look like a massive loss or a substantial gain simultaneously. So welcome, everyone, to a brand new deep dive on the DAP Advisors Ind AS Clinic podcast.
And that dual reality, that's what makes financial reporting so endlessly fascinating. And sometimes, let's be honest, incredibly frustrating for those on the outside looking in.
Oh, for sure.
There is this very strong illusion of precision. When people look at a balance sheet, they see numbers aligned in neat columns, they're rounded to the nearest decimal, and they just assume, well, those numbers represent an unshakable singular truth. But truth in accounting, it's highly dependent on the perspective of the entity that is actually doing the reporting.
Which brings us to our mission for today. We are going to untangle a very specific, highly complex web of intragroup transactions. We're looking at a scenario where a middleman subsidiary company sells its own subsidiary, like straight up the corporate ladder to the ultimate parent company.
Right.
And on the surface, it sounds like, I don't know, moving a $20 bill from your left pocket to your right pocket. But if that middleman sells the asset at a loss, the accounting mechanisms that kick in are just staggering. I mean, you can literally record a loss in one set of books and a gain in another for the exact same transaction on the exact same day. Okay, let's unpack this.
What's fascinating here is how it forces us to confront the philosophical difference between legal reality and economic reality. We're dealing with cross-border capital flows, conflicting accounting frameworks, and, the very definition of what control actually means when everyone involved is ostensibly playing for the exact same global team.
Yeah. And to navigate this, we are pulling a real-world case study directly from the massive issue repository on gapadvisors.com, which, if you spend any time in the financial sector and you don't know about the site, you need to. They host over 4,500 issues and detailed responses entirely focused on Ind AS and Indian GAAP.
It's arguably one of the most comprehensive, practical databases available for this specific regulatory environment. I mean, it's a goldmine.
And what I love is that any person can register for free on the site. You just submit your query regarding an Ind AS or Indian GAAP issue, and you get a thoroughly researched, incredibly detailed response delivered directly to the inbox of the email you registered with.
Which is huge.
It's a lifesaver for an auditor who is staring down a deadline and needs to meticulously document exactly how they addressed a tricky application of Ind AS. I mean, we all know that in auditing, if it isn't documented, it didn't happen.
Documentation is the absolute lifeblood of defensible financial reporting. When you're sitting across from a regulatory review board, you cannot just rely on a gut feeling. Having a resource that provides the technical paragraph-by-paragraph basis for an accounting treatment, well, that's what separates a robust audit from a massive liability.
Right, and this specific case we are unpacking today was actually featured in the 234th edition of the GAAP Advisors Task Weekly newsletter. It's authored by C.A. Manish C. Iyer, Director of DAP Advisors, and published on LinkedIn. And with over 230 editions published to date, it's basically a masterclass in applied accounting.
It really is. But before we dig into the actual mechanics of this specific case, we should probably establish the parameters of our discussion.
Absolutely. A bit of standard housekeeping. First, the views expressed in this deep dive are the personal views of the author of the newsletter and us as your guides today. They are not binding on you, the audience. We strongly request that you seek the help of an expert before taking any action or, refraining from any action based on the views we discuss herein, because every corporate structure has unique nuances.
Definitely. And we also need to set the ground rules for the scenario itself so we're all on the same page.
Right. The foundational rules for the entities we're discussing today. First, the functional and presentation currency for the Indian entity in our scenario is the Indian rupee. That means any currency other than the rupee is treated as foreign currency and subject to foreign exchange counting rules. Secondly, the reporting period we are looking at runs from the 1st of April to the 31st of March. Keep those parameters in mind as we build this corporate structure.
Let's start building that structure. It really helps to visualize this as a set of corporate matryoshka dolls. You know, the Russian nesting dolls.
Yeah.
You open the largest one, and there's a slightly smaller, distinct doll inside. Open that one, and there's another.
Okay, I'm picturing the dolls. According to the facts of the case from the JAP Advisors repository, our biggest, outermost doll is the ultimate parent company. Let's call them A Ltd. Now, A Ltd is an overseas company, and it prepares its financial statements following IFRS International Financial Reporting Standards.
So A Ltd is sitting outside the jurisdiction of India. It looks at the world through a globally recognized but very distinct framework.
Exactly. Then we open up A Ltd, and inside we find our middle doll. This is a 100% owned subsidiary named B Ltd. B Ltd is an Indian company, and because it is legally incorporated in India, it is governed by the Indian Ministry of Corporate Affairs and prepares its financials according to Indian accounting standards, or Ind AS.
And this jurisdictional boundary is the crux of the entire deep dive. People often assume that a wholly owned subsidiary is just like a branch office.
Right, just an extension of the parent.
Exactly. But in the eyes of the law, B Ltd is a sovereign corporate citizen. It has its own board of directors, its own statutory audit requirements, and its own tax liabilities to the Indian government. It really doesn't matter that A Ltd pulls the ultimate strings. B Ltd must maintain meticulously compliant standalone books under Ind AS.
Which leads us to the smallest doll. We open up B Ltd, and inside is another 100% owned subsidiary. We'll call this one C Ltd. And C Ltd is, again, an overseas company.
So the capital has taken quite a journey here. It flowed from the overseas parent into the Indian regulatory environment to capitalize B Ltd, and then flowed back out overseas to create C Ltd.
And here is the transaction that sets off the alarm bells. During the 2019 to 2020 reporting period, the middleman, the Indian company, B Ltd, decides to sell its entire investment in the smallest doll, C Ltd. And the buyer is the ultimate parent, A Ltd. So B Ltd is essentially passing the assets straight up the chain.
Right. B Ltd is transferring direct legal ownership of C Ltd to A Ltd.
But they don't just hand it over, they execute a sale. And the kicker is that B Ltd sells C Ltd to A Ltd at a loss. The transaction price, the actual cash consideration that A Ltd paid to B Ltd, was less than the carrying value of C Ltd, currently sitting on B Ltd's books.
A deliberate transfer at below the recorded book value.
Wait, let me stop you for a second, because my immediate reaction to this is, who cares?
How do you mean?
Well, if I have a really valuable vintage watch, right, and I give it to my son, and then 10 years later my son decides to give it back to me, but he sells it to me for $5, it doesn't change anything. As a family, we still own the exact same watch. The watch hasn't left the house. Why does the Indian regulatory system or the accounting standard even care what price B Ltd used if the subsidiary C Ltd ultimately stays within the exact same global corporate family?
That is the exact tension between the economic group and the legal entity. You're looking at it purely from the perspective of the global family, the A Ltd group. And you're right. I mean, from the top of the mountain, nothing has fundamentally changed. The group still controls all the underlying assets. But remember, our premise, B Ltd, is not just a pocket in A Ltd's trousers.
Ah, it's that sovereign corporate citizen concept again.
It's exactly. Let's test your watch analogy in the real business world. Imagine if B Ltd, the Indian company, had taken out massive loans from local Indian banks. Those banks lent money based on the financial health of B Ltd specifically. That health included the value of its investment in C Ltd. If B Ltd suddenly sells off a valuable asset at a steep discount, a massive loss to its overseas parent, those Indian banks are going to be furious.
Oh, wow.
The collateral backing their loans just evaporated and was shipped overseas.
I didn't even think about the local creditors. They don't have a claim on A Ltd. They only have a claim on B Ltd.
And let's bring in the Indian tax authorities too. If B Ltd sells an asset at a loss, it's going to record that loss on its income statement. It might then try to use that loss to offset other profitable operations in India, thereby drastically reducing its tax bill to the Indian government. The tax authorities are going to scrutinize that intragroup transaction under a microscope to ensure the pricing wasn't artificially deflated, specifically to avoid paying Indian taxes.
So the concept of transfer pricing comes into play. You can't just invent a number to move wealth across borders without triggering regulatory alarms.
Furthermore, while our specific case notes that A Ltd owns 100% of B Ltd, The accounting standards have to be robust enough to handle scenarios where there are minority shareholders. Say, if 20% of B Ltd was owned by the Indian public, and the company sold a valuable asset at a massive loss to the foreign parent, that is a direct expropriation of wealth from the local shareholders. Ind AS is designed to eliminate these transactions regardless of who owns what at the ultimate top level.
The auditor of B Ltd cannot just wave their hands and say, oh, well, it all washes out in the global consolidation. Let's not worry about the exact math.
Exactly. The auditor of B Ltd is signing off on B Ltd's compliance with Indian law. Full stop.
Okay, so if the regulators are scrutinizing this to that degree, it makes total sense why the querist on the GAAP Advisors platform was confused about how to actually document the books. Which brings us to the first query submitted to the repository. What will be the accounting treatment of this transaction in the books of B Ltd?
And the source material highlights a glaring but honestly incredibly common omission in that question. The querist asked about the books of B Ltd without specifying which books.
Right, because B Ltd has two completely different sets of ledgers it has to maintain.
Under Indian corporate law and Ind AS, because B Ltd itself had a subsidiary C Ltd, it is legally required to prepare both separate financial statements, known as SFS, and consolidated financial statements, known as CFS. And the treatment of this sale is radically different in each.
Let's break down the mechanics, starting with the separate financial statements of B Ltd. How do they account for selling C Ltd at a loss when looking purely at the standalone entity?
The separate financial statements are structurally simpler. In the SFS, B Ltd doesn't look at the day-to-day operations of C Ltd. It treats its ownership of C Ltd as a single static line item on the balance sheet called investment in subsidiary.
So it's just an asset sitting there, like a piece of equipment or a government bond?
Usually carried either at historical cost, meaning what B Ltd originally paid to create or acquire C Ltd, or at fair value under Ind AS 109. When B Ltd sells this investment, the accounting is a straightforward derecognition event.
Hold on, derecognition. So they just vaporize the asset entirely from the standalone view, completely ignoring what the subsidiary is actually worth on the ground today.
Yes. They remove the carrying value of that specific investment line item from the balance sheet. They then recognize the consideration received, the cash that A Ltd handed over. Because the facts state this was sold at a loss, the cash received is inherently less than the carrying value of the investment. B Ltd calculates the difference, and that difference is recognized as a loss directly in B Ltd's standalone statement of profit or loss.
Let's attach some numbers to this so I can visualize it. Let's say B Ltd originally capitalized C Ltd for 100,000 rupees. So the investment in subsidiary sits on the SFS balance sheet at 100,000.
Okay, simple enough.
Then A Ltd decides to buy C Ltd, but they only pay 80,000 rupees in cash. So B Ltd derecognizes the 100,000 rupee asset, records the 80,000 rupees in cash, and takes a 20,000 rupee loss straight to the bottom line in the SFS.
That is the exact mathematical reality of the separate financial statements. You remove the carrying amount, you add the cash, you record the variance.
But then we pivot to B Ltd's consolidated financial statements, and the entire framework shifts.
Because in the consolidated financial statements, B Ltd is not holding a single line item called investment. In the CFS, B Ltd has been consolidating C Ltd line by line for years.
Right.
That means B Ltd has been adding C Ltd's individual cash balances, its inventory, its physical property, and its receivables directly to its own. It has also been adding C Ltd's individual payables and bank loans to its own liabilities.
So the single investment asset is gone. It's been replaced by the actual granular reality of what C Ltd owns and owes.
So when B Ltd sells the shares of C Ltd to A Ltd, from the perspective of B Ltd's consolidated group, they're not just selling a line item. They're triggering a massive accounting event known under Ind AS 110 as loss of control.
Loss of control. That phrase carries a lot of weight in the standards. Why is control the defining metric here rather than just like ownership percentage?
Control is the entire philosophical foundation of consolidation. Ind AS 110 defines control as having power over the investee, exposure to variable returns, and the ability to use that power to affect those returns. Even though the ultimate parent, A Ltd, still has absolute control over the global empire, B Ltd, as an individual reporting entity in India, has unequivocally lost its direct power over C Ltd.
I see. B Ltd can no longer dictate C Ltd's manufacturing schedule. It can't sweep C Ltd's bank accounts to pay its own bills.
Exactly. That power has shifted vertically up the chain. So Ind AS 110 dictates that B Ltd must completely unravel the consolidation it has been doing for years.
And the source material directs us specifically to paragraph B98 of Ind AS 110 to execute this unraveling. And it's a highly prescriptive four-step process. Let's walk through these mechanics, because this is where the auditor really earns their fees. What is the first step? Paragraph B98, Part A.
Part A is the Great Purge. It states that if a parent loses control, it shall derecognize the assets, including any goodwill and the liabilities of the subsidiary at their carrying amounts at the date when control is lost. It also mandates derecognizing the carrying amount of any non-controlling interests.
So B Ltd has to comb through its massive combined consolidated balance sheet and surgically extract every single asset and liability that originated from C Ltd. Like if C Ltd had a fleet of delivery trucks, B Ltd must deduct the net book value of those trucks from the consolidated fixed assets.
And they must do this at the exact carrying amounts on the date of the sale. This requires a hard close of C Ltd's books on the transaction date.
And Part explicitly mentions goodwill. Why does goodwill get purged? I thought goodwill was an intangible asset of the parent.
Well, goodwill arises upon initial consolidation when the parent pays more than the fair value of the subsidiary's net identifiable assets. It represents the premium paid for expected future synergies, the value of controlling that entity.
Okay.
If B Ltd loses control of C Ltd, it loses the ability to direct those synergies. The accounting standard demands that this specific goodwill, which is inextricably linked to the power over C Ltd, is now irrelevant to B Ltd's consolidated group. It must be written off entirely.
Which brings us to step 2, Part B, recognition of the incoming consideration.
Right. Part B instructs the parent to recognize the fair value of the consideration received from the transaction that resulted in the loss of control.
Fair value is the key term there. In our scenario, A Ltd paid cash, so the fair value is just the cash amount, the 80,000 rupees from my earlier example. But what if A Ltd paid by giving B Ltd shares in a different company or like a piece of real estate?
Then the auditor has a massive valuation job on their hands. They cannot just accept a nominal stated value. They must independently determine the fair market value of that real estate or those shares on the transaction date to recognize the consideration properly. Part B also mentions recognizing any retained investment at fair value, but since B Ltd sold its entire 100% stake, there's no leftover slice to worry about here.
Okay, so we've subtracted all the old assets and liabilities and we've added the new cash. Now, Part C of paragraph B98 introduces the concept of other comprehensive income, or OCI. The standard says to reclassify to profit or loss or transfer directly to retained earnings the amount recognized in other comprehensive income in relation to the subsidiary.
And the treatment of OCI upon loss of control is one of the most mechanically complex areas of Ind AS 110. The source material actually dedicates a separate discussion to paragraph B99 to explain exactly how this works.
I want to bookmark OCI for just a minute because I want to finish the core equation of B98 first. Let's assume for a moment there is no OCI. What is the final step? Part D.
Part D provides the bottom line calculation. The parent shall recognize any resulting difference as a gain or loss in profit or loss attributable to the parent.
So it is purely an algebraic equation. You take the fair value of the consideration received, in our running example, that's 80,000 rupees. You add any retained investment, which is 0. You add any non-controlling interest derecognized, also 0. Then, from that total, you subtract the net carrying amount of all the assets minus liabilities minus goodwill that you purged in step A.
And whatever number drops out of the bottom of that formula is your recognized gain or loss on the loss of control. And crucially, it flows directly into B Ltd's consolidated statement of profit or loss for the year.
Let's test that theory with our numbers, because this leads us to the core anomaly the Gap Advisor's newsletter highlights. Let's go back to my analogy. Think of the investment line item in the separate financial statements, like a heavy, locked steel safe.
Okay, a safe.
B Ltd bought this safe years ago, and they recorded the price they paid for the safe itself on their standalone books. We said they paid 100,000 rupees.
Right, the historical cost of the investment.
Now, for the SFS, B Ltd never actually looks inside the safe. It just knows it owns a steel box worth 100,000. When they sell the box to A Ltd for 80,000 rupees in cash, the SFS math is simple. 80,000 minus 100,000 equals a 20,000 rupee loss.
Extremely straightforward.
But the consolidated financial statements demand a completely different reality. The CFS forces B Ltd to open the safe Ignore the steel box entirely and appraise the actual current contents inside.
The underlying assets and liabilities of C Ltd.
Right. So B Ltd cracks the safe open to execute the step to purge. And let's say that over the years, C Ltd, the contents of the safe, hasn't performed brilliantly. They suffered some operational losses, maybe a key piece of machinery depreciated much faster than expected. So when B Ltd adds up all the cash, inventory, and property inside and subtracts all the payables and loans, the net value of the contents currently sits at only 70,000 rupees.
The net carrying amount of the subsidiary has deteriorated over time.
Yes. So let's run the part of algebra for the CFS. B Ltd is receiving 80,000 rupees in cash, but the net assets they are giving up, the contents of the safe, are only worth 70,000 rupees on the consolidated books. 80,000 minus 70,000 equals a 10,000 rupee gain.
And there's the bombshell.
The newsletter specifically points this out. It says, quote, "It may be noted that loss on sale of investment in subsidiary in separate financial statements may result in gain on loss of control of a subsidiary in consolidated financial statements or vice versa," unquote. I mean, I am looking at the exact same transaction, the exact same 80,000 rupees of cash changing hands, and I have a 20,000 rupee loss in one ledger and a 10,000 rupee gain in the other. How does an auditor reconcile that kind of divergence without, losing their mind?
They reconcile it by understanding the mechanism of why the values diverged in the first place. Your safe analogy illustrates it perfectly. The carrying value of the investment in the SFS is fundamentally isolated from the operational reality of the subsidiary, whereas the CFS is intimately tied to it.
But why are they so isolated? Shouldn't the value of the investment track the net asset value of the company over time?
Under the cost method in SFS, no, not at all. It sits there at the historical purchase price, completely oblivious to whether the subsidiary is making millions in profit or bleeding cash every quarter. The safe's value doesn't change even if the gold inside turns to dust.
But in the CFS?
In the CFS, you're consolidating line by line every single year. So every time C Ltd makes a profit, that profit increases C Ltd's retained earnings. When you consolidate, that increases the net assets of the global group. If C Ltd suffers years of heavy losses, the net assets in the CFS shrink accordingly. The SFS cost basis ignores this operational drift entirely.
Right. What about cash moving between the entities, say dividends? How does that impact the divergence?
Oh, dividends accelerate the divergence dramatically. Let's say C Ltd generates a huge profit and pays a massive cash dividend up to B Ltd. In the SFS, B Ltd receives the cash and recognizes dividend income on its P&L. Crucially, the carrying value of the investment the safe doesn't decrease. It stays at 100,000.
But the safe is emptier.
Exactly, and the CFS reflects that. In the consolidated view, that dividend payment is an intragroup transaction. You eliminate the dividend income against the dividend paid. But the cash actually left C Ltd and moved to B Ltd. Therefore, C Ltd's net assets shrink. The contents of the safe diminish, further widening the gap between the SFS investment value and the CFS net asset value.
Which means when the loss of control event finally happens, the math formula in B98 drops out a completely different result. This paradox is a massive trap for a finance team that isn't paying close attention. If a controller just assumes, well, the parent paid us less than our historical costs, so let's just push a standard loss journal entry through all our reporting systems, they would fundamentally misstate the consolidated financial statements.
They'd turn a 10,000 rupee consolidated gain into a 20,000 rupee consolidated loss. I mean, it's a material misstatement that could easily result in audit qualifications and major regulatory penalties.
This highlights the immense value of having the GAAP Advisor's task newsletter and the repository, because these mechanical traps are rarely obvious until you're staring at a trial balance that makes absolutely no logical sense. Documenting the cognitive separation between SFS impacts and CFS impacts is paramount.
It really is. And we still have to unpack the bookmark we left regarding other comprehensive income, because the divergence gets even more complicated when you factor in equity reserves.
Right. Let's go back to Ind AS 110, paragraph B98, part C, which told us to deal with OCI, and points us to paragraph B99 for the specific rules. For anyone whose accounting theory is a bit rusty, what exactly lives in the other comprehensive income section of the balance sheet? Why isn't everything just put through the normal profit and loss statement?
OCI acts as a sort of holding pen for certain types of unrealized gains and losses. The accounting standards bodies recognize that pushing massive, volatile, unrealized swings in asset values through the main P&L would make it impossible for investors to understand the actual operating performance of a company.
It would distort the day-to-day reality of the business.
Precisely. Let's take the revaluation of property, plant, and equipment under Ind AS 16. Imagine C Ltd owns a manufacturing facility. Over a decade, the local real estate market explodes, and the fair value of that factory skyrockets. C Ltd revalues the asset upward on its books.
But they haven't sold the factory. They don't have the cash from that real estate boom.
Exactly. The gain is purely paper wealth. So Ind AS says we will recognize that increased value on the balance sheet to reflect economic reality, but we will park the corresponding gain in other comprehensive income, specifically a revaluation surplus reserve within equity. It bypasses the P&L entirely.
Another major one is the foreign currency translation reserve, or FCTR, right? Which is highly relevant here since C Ltd is an overseas company.
Very relevant. C Ltd likely operates in US dollars or euros, but B Ltd must present its consolidated financials in Indian rupees. Every year, Ind AS 21 requires B Ltd to translate C Ltd's balance sheet into rupees at the closing exchange rate.
And since exchange rates fluctuate constantly, the translated value of C Ltd's net assets will change every year, even if C Ltd literally does zero business.
That fluctuation creates a translation difference. And again, because this isn't an operational gain or loss, it's just a mathematical artifact of fluctuating currencies. Ind AS parks that difference in OCI, building up the foreign currency translation reserve.
Okay, so B Ltd has this holding pen full of OCI reserves specifically related to C Ltd. Now, paragraph B99 dictates what happens to that holding pen when B Ltd loses control. And the rule introduces a truly bizarre hypothetical scenario. I need you to explain the logic here. The standard says, if a parent loses control of a subsidiary, the parent shall account for all amounts previously recognized in OCI in relation to that subsidiary on the same basis as would be required if the parent had directly disposed of the related assets or liabilities.
Right.
Wait, you're losing me. Why are we pretending B Ltd sold the underlying assets directly? They didn't. They sold the legal entity, the shares of C Ltd. Why does Ind AS force the auditor into this alternate reality?
It's actually a brilliant mechanism designed to preserve the underlying nature of the gain or loss. The standard setters want to ensure that the method of disposal selling shares versus selling assets doesn't arbitrarily alter the accounting treatment of the historical economic events that created the OCI.
Ah, so it's about consistency.
Let's follow the standards hypothetical. If B Ltd directly sold the assets that generated the OCI, what would the specific rules for those assets dictate? Paragraph B99 outlines two distinct treatments. The first is reclassification, often called recycling.
Recycling back into the profit and loss statement.
Yes. The standard says, if a gain or loss previously recognized in OCI would be reclassified to profit or loss on the disposal of the related assets, the parent shall reclassify the gain or loss from equity to profit or loss when it loses control of the subsidiary.
Let's apply that to the foreign currency translation reserve we just talked about.
In AS 21 dictates that when an entity disposes of a foreign operation, the cumulative FCPR that has been sitting in equity must be reclassified from equity to profit or loss. It is recognized as part of the gain or loss on disposal.
But what is the underlying logic there? Why does the currency fluctuation suddenly become a real profit or loss just because they sold the subsidiary?
Because the sale crystallizes the economic risk. For years, B Ltd held an investment exposed to foreign exchange volatility. When they sell C Ltd, they are effectively converting that foreign investment back into a realized consideration, in our case, A Ltd's cash. The holding period is over. The cumulative impact of that currency bet is now a realized historical fact, so it gets pulled out of the holding pen and hits the bottom line.
So in our algebra equation earlier, where B Ltd had a 10,000 rupee gain on the net assets, if there was a cumulative FCTR gain of 3,000 rupees sitting in OCI, they would recycle that, adding it to the P&L gain, making it a 13,000 rupee total recognized gain on loss of control.
Exactly. It gets thrown directly into the income statement. But B99 has a second scenario, which is where things get truly granular. It continues. If a revaluation surplus previously recognized in OCI would be transferred directly to retained earnings on the disposal of the asset, the parent shall transfer the revaluation surplus directly to retained earnings when it loses control.
No recycling to the P&L here. It never touches the income statement.
Never. Let's go back to C Ltd's manufacturing facility. We established there was a revaluation surplus in OCI due to the booming real estate market. Under Ind AS 16, property, plant, and equipment, when you finally sell a revalued building, the historical revaluation surplus cannot be recycled through the P&L. The standard explicitly prohibits it.
But why? If you sell the building and get the cash, haven't you realized the gain? Why not show it as profit?
It relates to the concept of capital maintenance. The revaluation surplus is often viewed as a capital adjustment, maintaining the operating capacity of the entity in current value terms rather than an operational performance gain. And AS16 says that when the asset is gone, you can simply transfer that surplus directly from the specific revaluation reserve bucket within equity into the general retained earnings bucket within equity.
So it's just shuffling funds between two different equity accounts.
Precisely. So when B Ltd loses control of C Ltd, the auditor must look at that revaluation surplus. B Ltd applies the B99 hypothetical. If I sold that factory directly, Ind AS16 would force me to transfer the surplus directly to retained earnings. Therefore, upon losing control of the subsidiary, B Ltd takes that OCI balance and shifts it directly to retained earnings. It's explicitly excluded from that 10,000 rupee P&L gain calculation we did earlier.
I am genuinely struck by the sheer volume of forensic work required here. I mean, an auditor cannot just look at a net OCI number. They have to dissect the entire equity section of the consolidated balance sheet, trace every single OCI reserve back to its originating economic event within C Ltd, identify the specific Ind AS standard that governs that event, whether it's Ind AS 21 for currencies, Ind AS 16 for property, Ind AS 19 for employee benefits, and then apply the correct hypothetical disposal treatment to either recycle it to P&L or bypass the P&L entirely.
It's painstaking, deeply analytical work, and the margin for error is non-existent. If you recycle a revaluation surplus into P&L when you shouldn't have, you artificially inflate the company's reported net income for the year, misleading every single investor who reads those financials. This is exactly why professionals rely on the deep, paragraph-level analysis provided by resources like the Gap Advisors database. Seeing experts like CA manage CI or map out the logic tree is how you learn to navigate the minefield.
All right, we have thoroughly exhausted Query 1. We have resolved the middleman's dilemma. We know the mechanics for B Ltd's standalone books, the simple cost versus cash calculation. We have dissected the massive unconsolidation exercise for B Ltd's consolidated books, wrestled with the paradox of the P&L results, and navigated the hypothetical disposal rules of OCI, which brings us to Query 2, submitted to the repository. And this shifts our perspective to the top of the Matryoshka doll hierarchy. A Ltd, the ultimate overseas parent.
The entity that orchestrated this entire movement of capital.
Query 2 asks a very logical, almost common-sense question. Since B Ltd has sold its investment in C Ltd to A Ltd at a loss, does that loss get eliminated as a consolidation adjustment when A Ltd prepares its own global consolidated financial statements?
You can totally follow the querist thought process there. They know a loss was recorded down in the weeds by B Ltd, but since it was an intragroup transaction, a transfer between two entities under the exact same umbrella, shouldn't that loss just disappear at the top level?
And the response from the source material is unequivocal. It states, from A Ltd's perspective, the transaction of sale of C Ltd to A Ltd from B Ltd does not have any impact on its consolidated financial statements. Zero impact.
The rationale provided in the response is beautifully simple in its underlying economic truth. This is because A Ltd was controlling C Ltd, previously also, albeit through B Ltd. Therefore, any gain or loss recognized in the consolidated financial statements of B Ltd on loss of control of C Ltd shall be eliminated.
The ultimate parent just looks down at the transaction and shrugs. I own the factory yesterday through my subsidiary. I own the factory today directly. The economic reality of my global group has not shifted by a single dollar.
And that is the absolute truth from the perspective of the unified economic entity. No wealth has been generated from outside the group's boundaries, and no wealth has been lost or transferred to an external third party. The asset merely shifted from the left pocket to the right pocket.
To understand the actual mechanics of how A Ltd forces this transaction to vanish, the expert response points us to Ind AS 110, paragraph B86. This paragraph is the engine room of consolidation. Let's walk through the three pillars of B86 because it explains exactly how the magic eraser works.
The first pillar is paragraph B86, part A. It dictates that the parent shall combine items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries.
This is the brute force spreadsheet phase. You take the trial balance of A Ltd, the trial balance of B Ltd, and the trial balance of C Ltd, and you literally just add the rows together. Cash plus cash plus cash, revenue plus revenue plus revenue.
Exactly. It creates a massively inflated, completely inaccurate picture of the group's health, but it is the mandatory foundational step. You put everything in one giant bucket.
Right, because then you apply the filters. Pillar 2 is paragraph B86 Part B. Offset or eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary.
This step prevents massive double counting. Look at A Ltd's standalone balance sheet. It now has an asset called investment in B Ltd and, after our transaction, a new asset called investment in C Ltd. But because of step 1, we already added all the actual cash, factories, and inventory of B and C into the giant bucket. You cannot count both the parent's investment line item and the underlying physical assets of the subsidiaries.
That would be like saying you own a house and you also own the deed to the house, so you have two houses.
Exactly. So B86 Part B mandates that you eliminate the investment line items against the corresponding equity line items of the subsidiaries. Any historical difference between what was paid and the net assets acquired is categorized as goodwill or capital reserve under Ind AS 103 business combinations.
And then we reach the crucial pillar for our specific dilemma. Pillar 3, paragraph B86 Part C, eliminate in full intragroup assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group.
The magic eraser.
The standard is completely uncompromising here. It explicitly states, profits or losses resulting from intergroup transactions that are recognized in assets are eliminated in full.
Let's trace our specific transaction through this eraser. In B Ltd's standalone books, they recognized a 20,000 rupee loss. During the consolidation process, the auditor for A Ltd looks at that loss on the combined spreadsheet and says, that loss arose entirely from a transaction with me, the parent. It is an internal transfer pricing artifact. Eliminate it.
Erased. And what about B Ltd's consolidated books? We spent 20 minutes calculating that 10,000 rupee gain on the loss of control, dealing with net assets and OCI recycling.
The exact same fate. A Ltd's auditor looks at B Ltd's consolidated P&L, sees a 10,000 rupee gain labeled gain on loss of control subsidiary, investigates the source, and says, that gain was generated by selling the subsidiary to me. It is an intragroup gain. Eliminate it.
So the eraser wipes the entire board clean.
However, there is a vital caveat in B86 Part C regarding losses that we must discuss. The standard states, intragroup losses may indicate an impairment that requires recognition in the Consolidated Financial Statements.
Wait, that feels like a massive loophole. If the whole point is to erase intragroup noise, why would an auditor ever leave an intragroup loss on the consolidated P&L?
Because the standard setters are obsessed with preventing companies from hiding real economic deterioration. If B Ltd sold C Ltd to A Ltd at a massive loss, the default mechanical action is to eliminate the loss because it's intragroup. But the auditor of A Ltd must pause the spreadsheet macro and ask a fundamental qualitative question. Why was it sold at such a severe discount?
Was it just a tax structuring play designed by the lawyers, or is C Ltd actually a failing distressed business?
Exactly. If the underlying assets of C Ltd are genuinely impaired, say their primary manufacturing patent was invalidated by a court or their main factory suffered a catastrophic flood, then the value of C Ltd is truly declined. That is a real economic loss to the global A Ltd group.
So A Ltd eliminates the artificial intragroup loss generated by the transfer pricing invoice. But then Ind AS forces A Ltd to immediately test C Ltd's actual underlying physical and intangible assets for impairment under a completely different standard, Ind AS 36.
Precisely. If Ind AS 36 confirms the assets are impaired, A Ltd recognizes a genuine impairment loss on the global consolidated P&L. You eliminate the transfer pricing fiction, but you forcefully recognize the economic reality. It ensures the consolidated group's assets are never carried at more than their recoverable amount.
Okay, let's step back and look at the sheer scale of what we've just discussed. We've spent an hour agonizing over B Ltd's separate financial statements, derecognizing investments at cost. We've forensically reconstructed B Ltd's consolidated financial statements, calculating net assets, managing the intricacies of OCI recycling, and recognizing highly specific gains or losses. And then A Ltd comes along, runs the B86 consolidation process, and wipes the entire exercise off the board with a magic eraser. I mean, if every single drop of ink we just spent is washed away in the ultimate parents consolidation, I have to ask, isn't this entire painfully complex process just a massive, frustrating paper exercise?
It is tempting to view it that way from a purely global perspective, but taking that view ignores the gravity of jurisdictional sovereignty. This brings us back to the fundamental tension we established at the very beginning of the deep dive.
The difference between the global economic entity and the local legal entity.
Exactly. While the transaction washes out at the top level for A Ltd's international shareholders, B Ltd remains a distinct legal entity operating within the borders and laws of India. Its separate and consolidated financials matter immensely for statutory compliance. The regulators in New Delhi do not care about A Ltd's global magic eraser in London or New York.
They care about what happened within their borders.
The Indian Ministry of Corporate Affairs relies on B Ltd's Ind AS compliant financials to ensure it is adhering to corporate governance laws. The Indian Income Tax Department looks at B Ltd's standalone financials to determine its sovereign tax liabilities. If B Ltd recognized a 20,000 rupee loss in its SFS, the tax authorities demand to know if that loss is legally deductible under the Income Tax Act.
And taking that a step further, the accounting reality dictates the company's legal operating capacity. Think about dividend distributions. Under Indian law, a company can generally only declare and pay dividends to its shareholders out of its accumulated realized profits.
A critical point. Those legally distributable profits are determined strictly based on B Ltd's standalone financial statements. The gain or loss recognized on this intergroup transaction directly impacts B Ltd's retained earnings. Therefore, the transfer pricing of this internal sale directly affects B Ltd's legal capacity to distribute cash back to A Ltd or to reinvest in its Indian operations. The accounting isn't a paper exercise. It is the legal constraint mechanism.
And the complexity doesn't actually vanish when A Ltd uses the eraser, does it? The source material explicitly highlights one final crucial standard at the end of paragraph B86. It states, Ind AS 12 income taxes applies to temporary differences that arise from the elimination of profits or losses resulting from intergroup transactions.
In AS 12, the standard that ensures no accounting action goes unpunished.
How does erasing a transaction create an income tax issue?
It creates what is known as a temporary difference. Let's map it out. B Ltd recorded a 20,000 rupee loss on its SFS. Let's assume the Indian tax authorities accept the transfer pricing and allow B Ltd to deduct that loss on its tax return. B Ltd pays less cash tax to the Indian government this year.
Okay, so the legal reality happened. Tax was reduced.
But then A Ltd builds the global consolidated view. A Ltd uses the magic eraser and eliminates that 20,000 rupee loss. A Ltd says the group never suffered a loss. The asset, C Ltd, is still worth its original value.
So the accounting carrying amount of the asset in the consolidated view remains high, but the tax base of the asset, how the government views it, has been permanently lowered because the loss was already claimed.
Exactly. You now have a massive discrepancy between the carrying amount in the accounting ledger and the tax base recognized by the authorities. This discrepancy is a temporary difference under Ind AS 12. Because the carrying amount is higher than the tax base, it implies that when A Ltd finally does sell C Ltd to a real outside party in the future, they will have a larger taxable gain because they already utilized the loss deduction today.
Wow! So Ind AS 12 forces A Ltd to recognize a deferred tax liability on its consolidated balance sheet today to account for the tax they will inevitably owe tomorrow.
Precisely. The complexity of the transaction never truly disappeared when A Ltd erased the P&L impact. It just shapeshifted. It transformed from a realized loss line item on B Ltd's income statement into a complex deferred tax liability calculation buried deep in the balance sheet of A Ltd's consolidated accounts. This is the terrifying elegance of double-entry accounting and consolidation mechanics. Every single action is connected, and the ripple effects cross borders and standards.
This has been an absolutely phenomenal breakdown. We started with what seemed like a trivial question, a company moving a subsidiary up the chain to its parent at a discount. And we have navigated through the jurisdictional sovereignty of separate books, the massive unconsolidation engine of consolidated books, the paradox of conflicting P&L results, the forensic labyrinth of OCI recycling, the parent company's magic eraser, and finally, the shape-shifting nature of deferred taxes.
It highlights perfectly why a superficial, textbook understanding of accounting standards is actively dangerous in the real world.
Yeah.
You cannot just memorize the rules. You must understand the why behind the mechanism. Why do we maintain separate books? Why is control the trigger for consolidation? Why do we eliminate intergroup noise but preserve tax discrepancies? Only when you understand the underlying philosophy of the standard can you apply its mechanics correctly to a messy real-world scenario.
And as we wrap up this deep dive, I want to hand it back to you. After wrestling with the tension between the legal entity and the economic group for the last hour, What is the final thought you want to leave our listeners pondering?
We have seen how intensely complex the accounting becomes when an asset merely shifts pockets within the same corporate trousers. It reveals how financial reporting must rigorously balance two conflicting realities: the legal reality that these entities have their own sovereign stakeholders, and the economic substance that they operate as a single global group. My question to you, the listener, is this: does the relentless pursuit of fair value and complex unconsolidation mechanics in these intergroup transfers truly reflect economic reality, or has it devolved into pure regulatory hygiene? When we force a subsidiary to recognize a gain or a loss on a transaction that the parent company immediately erases, and then wrap the resulting discrepancy in layers of deferred tax calculations, are we genuinely providing more clarity to the global capital markets? Or are we just generating a highly structured simulation of reality noise that only auditors and tax authorities care about? Where is the line between meaningful financial disclosure and bureaucratic compliance?
We will let you sit with that profound question. Wrestling with Ind AS 110, Ind AS 21, Ind AS 16, and Ind AS 12 is no small feat, and we want to extend a massive thank you to the audience for going into the weeds with us today.
It has been a genuine pleasure unpacking the mechanics of this case.
If you enjoyed this deep dive and found the breakdown valuable, please make sure to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. You can find us on Spotify, Amazon Music, or YouTube, whichever platform you prefer to use for your podcasts. Hit that subscribe button so you never miss an analysis.
And we have a specific request to help grow the community.
Yes. Please share this deep dive directly among your contacts, send the link to your colleagues, share it in your audit team group chats, and pass it along to your corporate finance teams. And especially, please share this with any students you know who are currently pursuing their CA course. The theoretical knowledge they get from textbooks is vital, but seeing how these complex standards are actually applied to messy, conflicting, real-world scenarios like the ones meticulously documented on the gabadvisors.com repository is what truly bridges the gap between passing an exam and becoming a highly competent professional. Help us spread this crucial, practical knowledge on the application of Indian accounting standards.
The more we share these mechanical insights and debate the philosophy behind the rules, the stronger and more resilient the entire financial reporting ecosystem becomes.
Until next time, remember that the numbers on a page are never just numbers. Beneath the surface precision lies a murky, highly complex diagnostic landscape of eliminations, jurisdictional boundaries, and philosophical compromises. Keep questioning the numbers and keep diving deep.